What if instead of asking AI, what stock should I buy, you asked it to build a repeatable system that decides how to buy stocks? Because real AI models don't predict prices, they follow rules. So today, I'm going to walk through a simple AI-style investing system designed for January 2026, built around signals, risk control, and diversification. And when this system runs, it selects for stocks: AMD, PayPal, Nike, and E.L.F. Beauty. This isn't a prediction. It's an educational framework for how an AI could logically build a bullish stock portfolio, while removing emotion from the process. Most AI stock picks fail because people ask the wrong question. They ask, what will go up? A real system asks, what has the best risk-adjusted setup if conditions are uncertain? So here's the AI finance system. Step 1 is the universe filter. The system only considers liquid, well-established companies with real products, real demand, and enough data to evaluate long-term behavior. No microcaps, no hype names. Step 2 is the 4-signal score. Each stock is scored across 4 dimensions. First, demand strength. Is the product or service something people or businesses continue paying for over time? Second, competitive advantage. Does the company have brand power, network effects, switching costs, or technical leadership? Third, earnings power trend. Not short-term growth, but the ability to grow profit per share through cycles. Fourth, valuation versus reality. Not cheap or expensive in isolation, but whether the current price assumes a perfect future or a broken one. Step 3 is diversification. The system avoids picking for stocks that all win for the same reason. Instead, it wants different drivers of returns. Step 4 is risk control. No single position dominates the portfolio. If the thesis breaks, exposure is reduced. No leverage, no emotion. And step 5 is execution. The system only buys when a stock passes the signal threshold, fits portfolio balance, and isn't showing late-stage hype behavior. When this system runs in January 2026, it lands on AMD first. AMD represents compute demand. The world continues to require more computing power, from AI workloads to data centers, gaming, and enterprise systems. The system doesn't need to predict exact chip cycles. It only needs to recognize that compute demand is a long-term structural trend. AMD's competitive advantage comes from product execution and competing in high-value segments where performance and efficiency matter. For an AI system, the key question is whether a company can remain relevant in markets that are expanding. From an earnings power perspective, the system favors companies that can grow profit potential over multiple cycles, not just win a single quarter. And from a valuation standpoint, the system prefers moments when growth is real, but expectations are not perfection. So AMD becomes the portfolio's core growth and compute exposure. Next, the system selects PayPal. PayPal fills the payments network and recovery slot. Payments are not optional. Even when consumer spending slows, transactions continue. PayPal's advantage isn't speed or novelty, it's scale, brand trust, and network integration across online commerce. The system also understands that competitive industries create mispricing. If sentiment becomes overly negative, while the underlying platform remains functional and profitable, that creates asymmetric setups. From an earnings standpoint, established platforms don't need explosive growth to generate returns. Improving efficiency, margins, or focus can materially improve shareholder outcomes. So PayPal fits as a durable cash flow business with potential re-rating upside if execution improves. Then the system selects Nike. Nike represents global brand and cultural demand. People don't buy Nike because it's the cheapest product. They buy it because it's Nike. That creates demand that behaves differently than commodity goods. Nike's competitive advantage is brand equity, distribution, product design, and global reach. Brand power becomes a moat when it is earned and maintained over decades. From an earnings power perspective, the system favors companies that can preserve pricing power and scale globally. And from a valuation perspective, high-quality brands often get punished during weak cycles, even when long-term demand remains intact. So Nike becomes the portfolio's quality consumer and brand exposure. Finally, the system selects E.L.F. Beauty. E.L.F. fills the high-growth consumer momentum slot. Beauty spending tends to be resilient because it's relatively affordable and emotionally driven. That makes demand durable, even when consumers cut back elsewhere. E.L.F.'s advantage is speed, fast product cycles, strong branding, and viral-friendly marketing that converts attention into sales. From an earnings standpoint, growth brands that gain distribution and scale can rapidly expand profitability. Yes, high-growth stocks carry risk, which is why the system limits exposure and balances it with more stable names. E.L.F. becomes the portfolio's growth engine. It's not the entire thesis. So the system doesn't say, these are the 4 best stocks. It says these 4 stocks score well on demand, advantage, earnings, power, valuation, and together they diversify how returns are generated. AMD provides compute growth. PayPal provides payments and recovery potential. Nike provides global brand stability. E.L.F provides consumer growth momentum. Different engines, one system. If you want, I can run this same AI-style system on ETFs, dividend stocks, or the biggest tech names and show what it selects and why. If you want the advanced version, including position sizing, rebalancing rules, and risk management, comment system. This is AI Finance.